we have a guest that I'm particularly interested in, and that's John Tinsman, who is the founder of AOT Invest, which we will get to that in a second. And I'll tell you why I'm specifically interested in it, because again, I'm almost 61 years old and I'm looking out at the last third of my life, and I'm interested in what other people are doing with portfolio construction. That being said, let's go on to some housework. First of all, thank you to our sponsors, Independence Arc Farm in Arkansas. We always complain about big food conglomerates taking over the food supply, and they have. There is something we can do about it, and that's to patronize independent operators like Marco at Independence Arc. Also, at the American Gold Exchange, Dana Samuelson. If any of you guys got my speech from the New Orleans Investment Conference from 2 months ago, 1 month ago, I am now big into owning physical gold and silver. But feel free to hedge it in the paper markets if you're not that much of a bull. But if the leg higher that's going on now keeps going higher, it could indicate some massive problems. I'd rather be long the metal. Also, our main sponsor, unfilteredinvestor.com. John, I'm sorry that I have to go through all that. It's probably boring to you. You probably took 2 naps while I was going through all the housekeeping. But let's talk about you. First of all, I see snow in the background. So are you somewhere? Are you in Minnesota or somewhere? Or are you just in the Chicago area?
Yeah, so I'm from Davenport, Iowa. I'm here in Davenport, Iowa, when we filmed this. So born and raised, and I lived in Chicago for a little bit, working as a market maker and trader, but made it back here when I had kids.
Very cool. And you never made markets for me. We've never come across each other in the past. What products did you make markets in?
It was natural gas and crude oil and their options on them.
Oh,
So it
okay.
was mainly algorithmic, right? Like the
Right.
quoting and the eyes you use to maintain the markets
Okay.
electronically.
Good. Yeah. That's very cool. Well, good. Well, good to have you. So can you tell us first about how it progressed from AOT Invest into an AOT Invest ETF and what you tend to do for your clients? Can you walk us through?
Yeah, so I started investing when I was in high school, and I was doing it for my own money, and it eventually grew to doing it for my families, for my brothers, and then for my parents. And so, this whole time I was investing, I noticed that there was all the huge winners all had something in common, right? So, Nvidia's up 50,000% over the last 50 years. Microsoft's up 5,000%. Apple's up 5,000%. Google's up 5,000%. Meanwhile, companies like Boeing and Ford and 3M and Procter and Gamble, most of them are only up around 100% with dividends reinvested. And so you just look at that spread. And by the way, like 15 years ago, those companies, I'm not cherry picking the winners. Those were some of the biggest ones back then. Just like, 3M and Ford, those were also big companies back then. So, I noticed that what I came back to wasn't that it was technology, right? Or that information technology, because Visa's, in the financial services, in Google's in communication services, and, Microsoft's in information technology. What I came back to is low marginal cost. So these companies weren't just growing quickly. So they were growing their revenue very quickly, but they also had products that had low marginal cost products and services. And so I started that investment strategy and ran it in SMAs for my family. Eventually, we converted that strategy into an ETF. First of all, ETFs are very cost efficient. They're great for investors and they're tax efficient. So basically, an ETF manager can turn over a portfolio without recognizing capital gains for shareholders. So that was a big part of moving into the ETF space. And so my family and I continue to be, major shareholders in AOTG, which I launched as part of AOT Invest in 2022. So now it's been 3.5 years. It started trading on the NASDAQ at 2460. I think I see today it's around 55 or 56, 51, which is roughly 130% up in the last 3.5 years. So, I've been really happy to invest almost all of my money in it, and I believe in the long-term power of investing in high-growth businesses with low marginal cost products and services, because these companies, right? Like, what's it cost Visa when you swipe your credit card, or for 1 unit of Microsoft Excel? They have 100% profit margins. There's no constraints to growth. They don't have to go build factories that are funded by debt. And then they have so much free cash flow that they innovate very quickly. And that's very persuasive from an investment standpoint, that the company continues to stay relevant by innovating. And so, like, think about it. Like, ExxonMobil made a barrel of oil 40 years ago, but what have Apple and Microsoft done, right? They've transformed enormously, but it's also because they have 100 times more cash to spend and free cash flow as a percentage to spend on innovation. And so it's not any surprise that they innovate 100 times faster, to me.
John, you said You used a phrase, was it low marginal cost basis? What's that phrase you
Yeah,
just
so
used?
low marginal cost. It's the cost
Okay,
of one
so
additional
is
unit
that
to
very
sell.
similar to what we learn in economics classes, economics is scale? Is that basically what you're saying? But the economics are so unbelievable that they're literally, when they get to scale, the economics is zero. Is that what you mean?
Yeah, exactly. It's kind of like with your podcast. The cost of having one additional viewer to your show is nothing to you, right? Like you could add 10 million new viewers and it wouldn't cost you a thing. That's not like traditional industry. Ford can't sell 10 million new cars with no costs, right? The costs are enormous. And usually to grow in other industries. So, like, say Ford wants to sell 10 million new cars. Well, guess what? They've got to steal the business from Toyota, and Toyota is not going to hand it to them. So they basically have to sell it at a negative profit margin, and it's a knife fight, and you lose a ton of money, and it's funded by debt. And so basically, it's not growth is not um, like that in most industries. And so why not skip those industries when you're investing and invest in the best possible growth at the lowest possible valuation metrics within a low marginal cost universe? And that's what AOTG does and will continue to do. And it's a bit different because it also doesn't weight by market cap like a lot of leading indexes does. But that's a very persuasive reason not to do that as well. So it does go into the actively managed group. But like I said, that's only because when I do the back tests, that's what I find most compelling for performance.
So we don't prep questions here. Jim and I just kind of listen and go off the cuff, and you actually sparked a question. I am going to put you on the spot later, though. I do have a couple of prepared questions for you, but you just sparked something in me when you said that they don't, Ford has to maybe invest in new plants, maybe new equipment. They still have to buy the steel in order to make new cars if they want to sell more cars than they're currently selling. But somebody like Visa, and I assume you mean Microsoft and others, they have this low marginal cost basis. Again, I think I'm not saying the same phrase as you, but
Yeah, it's not
I have
cost
had
basis, but
enough
it's the
of
No.
low
this really
marginal cost.
masculine
Yes.
Low
energy
marginal
drink.
costs, right?
Yeah.
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 Drink another energy
Oh,
drink, Bobby. Shake it
yeah, I
off.
need to have more. I need to have more of it. But when you talk about that, does that mean, and I'm asking this question, I don't know the answer to this. Does that mean that they also are more susceptible to an immediate competitor who may do it
Ooh.
better? Is that the risk of that kind of a stock? Not for your ETF, obviously, because if
No,
you see
no,
the
no.
model
It's
is
a great
broken, you
question.
shift.
It's why a lot of people don't want to invest in technology. They think, well, it's not something I can hold in my hand, and anybody could come and make the next best thing, right? And you heard that when Facebook came out. They're like, well, everybody, look what just
Right.
happened to MySpace, right? Why would I buy Facebook? I think the thing about this though is that when you become a technology company and you're profitable, right? So you throw out the unprofitable ones. When you're a profitable technology company that's making $10 billion a year or even billion, and you've got a huge amount of free cash flow to continue innovating, it's very hard to surpass that, right? So there's natural moats that form in technology, right? Like everybody wants to use one search engine, Google. Everybody doesn't want to have a million different Word documents that aren't compatible with each other. So there's just one standard one, Microsoft Word. And so I think that there's some pretty compelling reasons to be in technology, but you have to remember when you invest in growth, right? You're investing in companies that are growing. So as soon as they're not growing, you're out. If the revenue growth is not there, you go into the next best thing. And so like right now AOTG doesn't have Apple in it, right? And Apple is one of the biggest companies in most growth funds, but it's barely growing faster than inflation. So why would you waste your time investing there in a growth fund? When people invest in growth, to me, they want the best growth in the market. So like some of my top weights also are Robinhood and Toast and AppLovin. I mean, these companies, Robinhood's growing their revenue 100% year over year. So you're talking about almost 50x higher than Apple, and that's what I want in a top weight in a growth fund, because I'm investing in growth because I want growth, not I don't want barely growth, right?
Yeah. So how has a company come onto your radar, and at what stage of their life is that? Like, I mean, Nvidia a year ago was growing its revenue, growing its earnings huge, but they were already kind of extended, and they've gotten more extended. They've had a volatile year. But where do you find like a company that's small and you say, boom, that's going to be the next one? How does that process work?
Yeah. So I generally skip the mid cap and small cap companies. So 10 billion plus, but generally more like 20 billion plus. And the reason for that is, look, like you could pull up the Morningstar charts. Do you remember that little box that they
Yeah.
make? And you see the small cap and the mid cap and it never beats large cap, and you see the value in the mid and it never beats growth. Like when you do like the 10-year and the 15-year, like the differences are enormous. And the reason for that to me is stock-based compensation. When you talk about these more technology oriented companies, where the smaller companies seem like they're giving away 30% of revenue in stock-based compensation. And that does not leave a lot of upside for investors. You get to a company like Google, or I mean, look, that doesn't have to be as big as Google. It could be a smaller one like Toast. But when you've got stock-based compensation in the single-digit percentage points, and they're doing buybacks that are bigger than the stock-based compensation, you're talking about the shares are shrinking. Like they're shrinking, they're always going down. So the ownership's being concentrated. It's the exact opposite of being diluted by enormous amounts every year. So there's some, like, a lot of people think like, oh, because it's smaller, it must have more growth potential, but it doesn't matter when their company's being diluted by more than it's growing at. So basically large cap profitable. And that's the other thing you're going to say, whoa, profitable. And that's one of the reasons why I started at AOTG. There was a lot of high growth funds in the market, but most of them focused on enormously unprofitable and speculative companies. So these could be companies. There's a famous one out there that's like basically like making big bets on Ethereum being big. And you're like, that's just pure speculation. There's other ones, right? Like ARKK was investing a lot in like CRISPR and Intellia. And they were saying this company is going to cure these genetic diseases. And there's the closing bell. And
Oh yeah, again, bang, ding, ding, ding. Right.
But basically, like that is quite a bit of speculation because it actually hasn't done that yet, and it doesn't really have a product out there in the market. So I try to stay away from that. And I do like those companies like NVIDIA more, right? Like it's been a main top position really since inception of the fund in 2022. And the reason for that is that it has very low marginal cost, but also, for much of the past 3 years, it's been growing at 60, 70% plus. It continues to have 60% revenue growth, right? And that is some of the best growth in the market. So NVIDIA is the top position in AOTG, not because it's the biggest company in the world, but because it has some of the best growth in the world. And this is a high growth fund.
That's amazing. Okay. By the way, just by the nod of your head, when you were talking about the Ethereum fund, is it run by someone who has the same name as a famous drummer?
Yes.
Okay.
That's not what I want in big positions and long-term investments. I don't want speculation. I want the companies that are actually doing it and who's innovating faster. The best way you can tell innovation is just really high revenue growth, because if there's so many people clamoring to get their hands on the product, that's innovation to me.
But hold on. So what you're saying, because we talked about this and why I was interested in this, because I'm someone of a certain age who's looking at retirement at some point in time in the fairly near future. Again, my retirement is going to be different than what most people think of it. I will trade and analyze and do whatever forever. But this to me sounds like it could be susceptible to a massive downturn in technology if certain names that it might not even be in your ETF, certain names get stretched like Apple, and all of a sudden you're rotating to the ones that aren't stretched. But if the bottom falls out, oftentimes the good gets thrown out with the bad, the baby with the bathwater, whatever you want to do. Is there ways, do you feel that a downturn could make older people susceptible to losing capital?
So I would say that whenever you invest in things that are going up a lot, there's more downside potential as well. Right.
Right.
So I don't mean downside in the long term, but I mean in the short term, there's going to be more price discovery as the market tries to figure out what is this worth. So like last month, for example, or 2 months ago, we saw Micron go up by like 90 or 80%. And then we saw the next month it dropped by 20%. Now, like that seems like, whoa, that just went down by 20%, while the S&P 500 only went down by 5%. But you can't leave out that it went up 80% before. And so there's always going to be some price discovery. And you see that in companies like Robinhood going up to 140 and coming down to 110. And now it's back up almost at 140. That's not a good reason in the long term not to invest in them. But I would say this, when you invest in companies, like let's just take Robinhood, right? So it's growing its earnings at 150% year over year. It's growing its revenue at 100%. So if the stock drops 30%, and over a year, it continues to grow its revenue at 100% year over year, you're talking about valuation metrics that would be falling by 70%, right? And that is, I think, quite uncommon. And I think in the long run, fundamentals, so that is like the actual revenue and the earnings of the companies, that is the best long-term correlator. So if you really can nail the ones that have the best earnings growth in the market, I think eventually the stock price will follow it in the long term very closely.
So I'm not entirely sure how much you look at this, but I spoke at Robinhood's Hood Summit in Las Vegas, and I don't know if you've ever been to one of those. Their customers are loyal. I mean, it was like an Apple conference back in the day, before the founder, before Steve Jobs passed away. It was like that. It was like there were rock stars on the stage, and Jim and I know a couple of them personally, and we're trying to do more with them, quite frankly. But I don't know if that's something you ever look at, but I just want to point that out. I want to put something on the screen if I could. I'm actually going to put 3 things on the screen real quick. This first one is.
While he's putting them up, John, what's the ticker symbol of your ETF?
AOTG. And the website is AOTETF.com.
Got it.
All right. So this first one is AOTG versus the Russell. The Russell being the one on the bottom in the red.
Yeah, it's not even close.
It's not even close. All right. Next. And then I have a question. I'm going to stop on the last one.
Yeah.
Share something else. I'm not really great at this, so give me a second to pretend like I've been doing this forever.
It's not going to surprise John that 2 old guys are not very good at the technologies from.
So
it's not going to surprise him.
Something that's really interesting. So when I was doing like the research of creating the strategy, so this was a while ago, but I put up all these funds up there, and the NASDAQ has beaten the S&P 500. You guys are aware of that, right?
Yeah.
And that the information technology sector has beaten the NASDAQ, right? And in between there, you've got like the Vanguard Growth ETF and Charles Schwab Growth. Do you know, like, if I went through those portfolios and did what percentage of the company or of the portfolio is low marginal cost, and the performance ranking when I did that was almost 1-to-1, like correlation of the more low marginal cost. That was how it was ranked in terms of performance in the long term. But none of them got anywhere close to 100%. Right. So like there's like technology companies like Uber, right? But like really the cost of one additional ride is very expensive. So like that's not a low marginal cost company. It can't scale the same way, things like that. So it's like, yeah, I thought it was very interesting. That's like the reason I think the NASDAQ has crushed the S&P 500 and why the information technology does even better than the NASDAQ and why AOTG since inception has beaten all of them.
Well, let's look at that because this is SPY against EOTG.
Solid beat.
I'm sorry, AOTG.
You've got so many lines on there. I'm like, it's like really
well. That's why I couldn't change my whole charts for this. So
it's the blue one.
This basically is the bars above the blue line is the S&P, and the price action above that is your ETF.
Nice.
All right. As an active trader, I'm going to have a lot more lines than anyone else.
We have our moving averages. Our system is built into that, John. So.
Yeah, I can't change those things, but I can put this up and I can explain this one because this is the one that I want to stop on anyway. And it's going to be, I'm really good at this. So give me a second. Here we go. So this is going to be, now let me explain everything on here before I ask you the question. So this solid purple line down here, okay, this is the Qs. Okay, this red line is the 200-day moving average of the Q, or I'm sorry, of your ETF of AOTG. And then all of these candles here are the performance on a daily basis, a daily chart of your ETF. And then don't worry about these. These are our moving averages that we use, Jim and I, and our analyst Mike, who is really he owns us more than us owning him. But so what this basically shows, and anyone who regularly watches our show has seen all of this mess above here, okay? What this basically shows is that I'm going to pull a number out of my ass. It would seem to me that about 99.8% of the time you're outperforming the Qs. Okay, that's what this chart is showing me. Now, there's a couple of things I want to point out on it before I ask you a question. Number one, there are drawdowns in here. Okay, I used to be an investment officer to fund of funds. And whenever we saw something that was performing really well, okay, we went and looked at the periods where their holdings would be performing poorly and looked at their performance during those times. Not just the performance of the fund, but how you would actually act in that situation. Would there be style drift at times when you're losing? Would you try to buy puts to offset it? Any of that stuff. And I can see you smirking, so I know you don't do that. But
yeah, I know.
We do have drawdowns in here, right? We've got this drawdown here. that I'm pointing to with, well, I'm actually not pointing it to it. Hang on, let me show you here. We got this drawdown right here, which is like in August of, it looks like 2024. Then we got this obvious drawdown here. That was a little while ago
Liberation
when
Day.
NASDAQ lost
Yeah,
about 7%.
it's hard to tell
right?
because your line does that only show the daily move, or is that because you might not see the daily variation in the QQQ?
No,
or
there's
you might
not in the NASDAQ. You don't see the daily. These are closes, right?
Yeah.
And I don't even care about that because still you outperformed. Like even in the drawdown periods, the NASDAQ obviously was worse on a daily basis. And all I have here is the closes because that always happens with the indexes. So what I'm asking you is, this has obviously been a bull market with pullbacks in it. Okay. What happens? Does your fund make any sort of adjustments if a bear market happens? Because you haven't really been around for one.
Yeah. So I would say, all right. So
because you outperform to the upside. There's no doubt.
yeah. So basically, when you focus on profitable companies, so you're not focusing on the unprofitable, that's one way it improves, in my opinion, on the QQQ. So you don't have any unprofitable companies on there. So Spotify starts losing money, boom, it's out of the portfolio, right? So I mean, I think that takes a lot of risk out. And in a recession, you'll start to see companies swing to losses, and maybe those management teams aren't as good at managing the inflows or the revenue variations, right? So I think that the long-term strategy of focusing on profitable companies helps you in the upturns and it helps you in the downturns. 2, the revenue growth. I believe that even if there's a downturn, the companies that have with the most innovative products that are saving people a lot of money continue to grow. So I think we've seen in a lot of recessions in the past, certain companies, say like a software company that's allowing people to reduce their employee count by providing better, software management services, right? So like you even had like '08, but with the credit cards, people started moving further into credit cards, and Visa did quite well. So I would say that when you focus on when you're a true pure growth fund and you focus on that, that provides you some good downside protection as well, because you get out of the ones that start losing money as soon as, or not losing money, but they stop growing or they lose money, and you're out of them. You're the first one out, right? Like you can act faster than an index can, and then you focus on the ones that continue to have the best growth and innovate the best and grow their profitability. So I would say that it's not like it takes any drastic changes in a downturn. And right, like it has been through, like you said,
You have been through downturns.
the Trump trade wars and all of that stuff, right? And I was running this strategy before during COVID, right? And we had that, it was really a huge explosion. It was great. And then 2022 was a bit of a hit. I think the information technology index went down 35%, while like the S&P 500 might have only been like 26 or 27%. So like you can see that there's a little more downside at times, but also like in 2023, AOTG went up by 54%, and I think like the S&P 500 went up by 30%. So
John, I was just going to actually say something because I've been collecting some data too, and I think I'm going to make your point as well from an unbiased source. So in the Liberation Day bloodbath in the NASDAQ brought it down about 26 or 7%. The brought down the AOTG by probably a little closer to 30%. You guys are like, oh, that's worse. No, it's not worse when you consider the fact that AOTG was beating the shit out of the NASDAQ for several years. I would have expected, like, when you see that kind of outperformance, I'm very, very encouraged by an almost exact same down move in what was, generally speaking, a bloodbath. So I think that those numbers really support that you have, decent downside protection. But that was, I was going to, you finished what you were going to say.
Well, I mean, think about it. So the NASDAQ's beating the S&P 500, and you ask yourself why. And I say, well, it has more low marginal cost. It has, and it has higher growth companies. Well, then the question is, well, how do you beat the NASDAQ? Well, you have more low marginal cost and more high growth companies, earnings growth companies in your one. And so statistically, like I see my portfolio metrics, the weighted average portfolio earnings growth is like 90% year over year. Yeah. Right. So the S&P 500, I think that's like closer to like 10%. So it's growing 9 times as fast in earnings growth. I think that gives you the best chance of having really high returns, but also the best chance of, in over a 1 to 2 year period, having a very low risk of doing worse.
So tell me this, when you're looking at and you're talking to someone, I assume you meet with clients, high net worth people, and do things outside of the ETF, or is that not correct?
So I do that for my family, but AOT Invest has one client, and
Okay.
I like the stuff I do for my family. That's just what I do. It's not like within AOT Invest. I don't charge any fee for it, but but for AOT Invest, I have one client and it's AOTG. So this is all I do, and I don't meet with other people.
Okay, so this brings my question then. So you're obviously a young man and have much more of a stock allocation than someone who's 70 years old, clearly,
Yeah.
but as well you should. Now, when you're thinking of someone, again, this could be just, I know you don't do this, but you're thinking of someone who is 70 years old, and you're talking about a balanced portfolio, but replacing stock exposure with the AOTG, which to me actually is not a bad thing. That's what you're saying. You're not saying that a 70-year-old is stupid if he doesn't have every penny of his money in this sort of strategy.
Well, at that age, you should probably have like 2 years of like living expenses and cash, right? So you probably have a money market fund, and then the rest I would probably leave in equities. And like for me, like when I'm 70, I think it would probably be very comfortable leaving it in AOTG. But then you sell sections of your equity, and maybe because you have 2 years of living expenses, if there's a sharp downturn like in the Trump trade wars, you try to hold off on selling a little bit until the market starts to rebound. And so I mean that's what I would personally do, and that's not for everybody. But to me, when you meet these people and they have financial advisors and like they're like investing in like emerging markets, so like China and Russia, and then they've got like all these international bonds, and you're like, it just doesn't make any sense. You're like, why would you hold Venezuelan bonds over like the money market funds in the US? Like that's like there's
Amen.
diversification, but diversification that lowers your returns and increases your risks is the dumbest things anybody has ever heard. So
Well said.
AOTG is a diversified fund. So it like meets the SEC requirements of a diversified fund, but it tries to concentrate using common sense in what has the lowest amount of risk and the most like upside, in my opinion. So like to me, I feel very comfortable with that. You don't want to diversify into companies that increase your risk and lower your return. And so like I view those companies as like the Boeings and the Fords and whatever. And like it's not that I don't love those companies. I just don't think they offer as good of opportunity for investment for myself. And so even when you're 70, I think when you invest in growth funds, you can always sell a 5-10% of your shares every year, and still if the fund like goes up 30% or 20%, you're still growing your investments quite substantially. A lot of people seem to think that they need income, and so they need these dividend funds and stuff, but like the Charles Schwab dividend fund and other ones, like a lot of them haven't done anything like that. For like you can look at like a 5-year period, the returns are very negligible. And meanwhile, you've got growth funds or like the NASDAQ, like, right, like they're up 100%. And you're thinking, why would, it doesn't matter if you have a 2% dividend if your return isn't anything. I would much rather have the NASDAQ or, a growth fund like AOTG and sell a section of the shares when I'm ready for my withdrawal. And I would pay actually lower capital or lower taxes on it at long-term capital gains than I would taking dividend distributions at regular income.
Love it. Is there a chance you can open your window and ask that guy walking back out the window there if he invests in AOTG? That's what I want to do.
that guy does, I think.
He does. Okay, good. He does for sure. By the way, I'm very, very intrigued about this, and I actually think I'm going to be buying some tomorrow. I think it's very interesting. Bobby?
I'm honored. Thank you. It'll be great to have you on.
Yeah, no, I actually like this for me as well. And one of the reasons we titled the show what we did is because Jim and I are around the same age. He's a little older and a little shorter.
Oh, you always have to say it. I'm a little taller though too. Did you say that too?
He's a little shorter and a little bit older. Not much in either case, but we just have facts are facts. But we have to, Jim and I get the same questions all the time. And Jim and I are both traders. We're not wealth managers. We both have had experience with wealth managers. I just mentioned to you that I was in a fund of funds for 8 years. So I was actually on the investment committees for emerging managers, and you're just outside the window of what I would call an emerging manager, even though you're not actually, you're managing the ETF, right? So basically what I'm asking is this. We get calls all the time from our younger relatives and friends who are like, oh, my uncle knows that, call him. I just got some money to invest. What should I invest in? And the standard answer, because I don't feel responsible, I don't feel like it's responsible for me to say, oh, you should definitely get in Rigetti computing today. I don't do that. I go, look, you're like 22, just buy the Qs and don't worry about it. It sounds to me like I might have a new recommendation for
Right.
them.
This may be a
Now,
little better than that. Yeah.
yeah. Now, having said that, they're 22. Okay. So I guess my question becomes, first of all, am I correct in telling the 22 to 42-year-olds, I don't think it should be the Qs anymore? I mean, the chart shows me that. And if you're doing this in a bull market, you're clearly going to continue to do it in a bull market. But do you take like a valuation filter and say, okay, NVIDIA is profitable. NVIDIA has, to get another customer, it doesn't cost them a dime. Well, maybe with NVIDIA it does. But anyway, do you look at that and say Visa doesn't cost them a dime to get a new customer, but their valuation is too high? Or do you have some sort of a filter where you go, look, there's going to be a sell-off in this stock, regardless of them making money or not?
Yeah, so like Palantir is no longer in the fund, right? And
Oh, there you go.
think about this. You could have a company that's growing faster. Let's just say Robinhood, they're or AppLovin, right? AppLovin's growing at 70% year over year.
I
Revenue
think
growth,
Robinhood's a
much
great
higher earnings
example.
growth. Robinhood's at 100%, right? Or you could have a company like Palantir, which is growing, I think, closer to 50%. But Palantir is a price to sales of 100, and Robinhood and AppLovin are below 25. So like, imagine this, you're going to go buy a company. These other companies, by the way, have way more revenue. They're way more profitable, but let's just pretend they all have the same amount of revenue and same profitability, which they don't. But let's just say, you've got, they've got $1 billion of revenue each. And you said, okay, this one will sell me the business for 25 billion. Or by the way, that other one over there will sell it to me for 100 billion. And you've got $25 billion to spend. And you're like, you know what? I think I'll buy the cheaper one, which is also more profitable and growing faster and everything else. But like, what do you think an index does? An index like the QQQ only weights by market cap. So it buys more actually of the more expensive business. And that's like the exact opposite of what somebody like Warren Buffett does. And so there is a quality factor. And I think people call that quality of like, the valuation metrics that I add in. But really, like for me, when I do a rebalance, what I always want to do is I want to raise the growth metrics. So whenever I'm doing a rebalance, I want to raise earnings growth. I want to raise revenue growth. At the same time, I lower price to sales and PE ratio. So I do that every single time I do, or I try to do that every time I redo a rebalance.
You just hit on something why I'm so intrigued in this is because of the distortions that have been created by passive investing. And as those companies' price shares go higher, it's more and more. So it's like this feedback loop that is positive on the way up, but negative as shit on the way down. That's why I really like this lot. I didn't mean to interrupt you, Bobby. I interrupted you.
You can't do that in an index that's weighted by market cap. It's just not possible.
It's not possible. So that's very, very interesting to me.
That's why I look, if I thought the QQQ would beat my fund, I would put my money in the QQQ. Like I did this because I was investing in a way to try to beat that before this and wanted to do it in a tax efficient manner, like all ETFs are. So I'm not doing this to try to lose against the QQQ. Now, and that's why I feel comfortable going into the future, continuing to put all of my money in AOTG.
Is there an options market?
You have to have a benchmark. You have to. And I appreciate you saying that. I don't know if that's your benchmark.
It is though, right?
All the time.
I think like on the prospectus, the S&P 500 is the benchmark.
You're crushing.
The NASDAQ continues to grow in relevance. Even when I launched the ETF, the QQQ, like think of like the investment flows that has gone into that. It was not so mainstream as it was, even 3.5 years ago. But I would say that the QQQ is a better, more realistic benchmark. Being that it's more similar to AOTG, but most people, when they want a comparison, they want the S&P 500.
And the reason I bring that up is because you have so many people. Like I spoke recently at a Bitcoin conference. Jim has done it as well. I think I'm speaking at another one in January. Jim, I think I'm actually interviewing Natalie Brunel, and I'm supposed to fight with her, right? Yeah. And they'll say things like, well, yeah, this is doing really well, but look at Bitcoin. And it drives me crazy. Like that completely drives me crazy because it's like going, this apple is delicious, but look at that orange. It's just dumb. They're two different things and they're for two different purposes.
It drives
anyway, that's why I bring that up.
I don't want to alienate the Bitcoin people, but like usually when you talk to them, but usually when you talk to them, they think, well, this is a store of value because it's rare. And you start comparing it to companies like Google or Visa or Microsoft. You know what these companies are. They're even more rare. One, two, they do buybacks. So they're actually buy back. Bitcoin doesn't buy itself back out of existence. So it's more rare than Bitcoin. It's only getting more rare where Bitcoin is obviously not buying itself back. So it's a better store of value. And then third, it innovates. So the company continues to innovate, provide like, Microsoft's like, oh, we've got like, this Office suite, but what if we make Teams and charge twice as much for that? And why don't we make Copilot after that and charge 3 times as much? And people use them because they provide lots of value. So Bitcoin isn't like changing like that either and innovating. So you have multiple tiers of why I think in the long run, investing in companies like this is a much more compelling play than Bitcoin. And any argument you can make for Bitcoin based on, like as a store of value or rarity, I think is even more compelling when you use companies like AOTG invest in.
Jimmy, we've got a question from Widge, and I never want to ignore a question from Widge. We get questions from the live portion of the audience, John. Yeah. But the question is, have you spent much time studying and considering the 2000 to 2003 NASDAQ and how you might respond to something like that?
I love this. People, they're reading my mind. I want to talk about this.
Awesome. Which is great, by the way. If you're ever on, I don't know if you're ever on Twitter, but if you're not, you should, or if you are, you should follow him. He's great.
Nice. I will. So basically the NASDAQ was not a very profitable portfolio, right? Like most of the companies were losing money back in 2000, right? And they were losing a lot. Okay. What is different about the NASDAQ today is it has a profit margin of 16%, where the S&P 500's profit margin is like 12 or 13. So it's making like 30% more money, but like per bit of revenue than in earnings than the S&P 500 is. And so I actually think like I did all the back tests when I was making this. I've never been able to create a portfolio that makes more money than a profitable one. And people are like, wait, but you missed Amazon, right? And it's like, no, you missed Amazon, but if you invested in Google and Microsoft, you did just as fine. And for every Amazon you invest in, there's like 10 pets.com that go bust, right? So like you had no losses in the Google, Amazon, Apple group, but you have lots of losses. Well, maybe Amazon did great, but you forget like so did Microsoft and Apple and Google. So it's like you actually raise performance that way. And so when you have a portfolio like AOTG that focuses on very profitable, high earnings growth company, it's totally different than like the NASDAQ of 2000. And by the way, I wouldn't have invested in the new NASDAQ of 1999 or 2000, focusing on profitable companies. But the NASDAQ today is a very different thing. And I think it's way more investable because it's more profitable than S&P 500 and it has better earnings growth. So I would choose the NASDAQ today, any day over the S&P 500 because of those fundamentals are much stronger.
So, John, is there a options market associated with the ETF?
I don't think so. I generally I don't trade options.
Right.
So,
yeah,
I haven't checked, but I don't think there's not a ton of volume in AOTG, right? So AOTG is just under 100 million in assets now, so it's not as widely traded as some of the large ones. But that being said, the liquidity is very good there when you go to place orders.
Right. I'm paying attention. I'm just looking at what the holdings are in the fund, but for some reason my Bloomberg's not working very well.
John, while Jim's looking at this, when you talk about, you said when I rebalance, how active are you? Are you doing monthly? Are you doing quarterly?
Yeah, at least quarterly.
At least.
And then more often as I need to, but I generally am a long-term buy and holding. So the idea is not to turn over the portfolio a lot. You wait for the next earnings to come out. You decide, okay, how am I going to structure this so that I raise the growth metrics and lower the valuation metrics? Because I think that's the long-term strategy to win every time you do a rebalance. And so like in my last rebalance I did, it was taking out companies like Spotify that their revenue growth had slowed. And they'd actually turned unprofitable. So boom. And then I invested in companies like AppLovin just because they were growing much faster and they had better valuation metrics. And, AppLovin since that time is up 44% and Spotify is down 16%. So that's how you do a good rebalance, in my opinion.
So I'm not trying to be a jerk about it. I almost said the D word, Jimmy.
Why did we not say the D word? I thought we did.
That one I don't like. I don't care about shit.
Yeah. These names are making a comeback.
Right.
No,
it's okay now. You're not going to offend anybody.
No, I want to really get into when you say as often as I need to. What does your day look like? Like, do you saying the stock's going down, let me check and see if they're losing revenue? Do you just watch the earnings of all your holdings? What does your day look like? Like, how does that How does that happen on a day-to-day,
so
week-to-week
I
basis?
watch all the holdings, right? Like I've got a watch list. It's got all of
Of
them. So
course.
I'm watching them, I'm reading about the news on them, but I kind of tinker with the portfolio and potential rebalances until I feel like it's time to make a real one. And usually that's just quarterly recently. In the
Okay.
past, it was more like monthly or even twice a month. But I've, I try to like, I track every single trade I make and I know what's made money and what's not, what rebalances, which one were the most successful. And I feel like it makes sense for me using the data to say, you do it once a quarter, wait till you have all the information available of the newest earnings, and then do one big change all at once. And so I also don't turn over a lot of the portfolio because guess what? The companies growing the fastest today are happen to be, it's the best indicator that they'll be the fastest growing tomorrow. And so the best earnings growth. So I think like in the prospectus, it says my last year's turnover was 17%. So only 17% of the fund got turned over. That's a little more probably than an index, but it's much lower than the typical active fund.
So I have a list up here of your top 15 holdings, which is just, public information. And what the secret sauce is the metrics when he makes different changes. What of this top 15, what's the newest addition? Do you remember that off the top of your head or no?
So Robinhood and AppLovin were probably both added.
And by the way, is AppLovin, is that a play off McLovin from Superbad? Is that why it's called that, you think?
I don't think so.
It is.
Oh,
It
it
100% is. I don't care what they say.
I would bet that it is. Yes. But anyway, finish your answer, John. I didn't mean to cut you off, but Superbad is important. We would all agree, right?
Right.
100%.
So a lot of the newest additions are the companies that were unprofitable before, but I felt as they were growing in profitability that it was time to go in on them. So AppLovin and Robinhood. So AppLovin was actually in my portfolio at the beginning of inception, but Robinhood was something I added in the last year.
Oh, and by the way, so when you then sometimes when it's rebalancing time, do you then increase a position in a certain name if the metrics on those are getting better?
Exactly. Right. So
interesting.
So,
Okay.
yeah. So basically imagine you have one deteriorating and one getting better. That's where you change around weights. And so half of rebalances are doing just that. And the other half is cutting names and adding new ones.
Wow. This is really cool stuff, Bobby.
So probably I wouldn't necessarily say it's the last question I have for you because it depends on what your answer is. What is your goal for this? Is your goal to get this to a certain amount and then just kind of like ride the
Great
gains
question.
on it? Or do you have other funds in mind already? Or I should say ETFs, not technically funds, but
Yeah, it's a good question. So, I mean, I believe in doing this because I believe in the investment performance and its long-term capabilities, right? So hopefully I do this my whole life, right? And they say legacy is a ticker that lives on forever. So, I mean, when you're in the investment management industry, ideally you can achieve in the long run a 20% annualized rate of return or more, and AOTG is well above that since inception right now. But at that rate, you double your assets every 3.5 years at 20%. So there's, I think it will get to a good size, but I'm not really focused on the asset, like the AUM. I care about, and as like one of the largest shareholders of it, I care about
the
performance way
Yeah.
more than the AUM. So a lot of ETF companies are out there and they're selling you funds that they don't own themselves. And they're more focused on marketing, where my main focus is, like you can see, there's barely any marketing at all on AOTG. That's probably one of the reasons why it's so small, even though it has really good performance. But AOTG is, something that, there's nothing else out there like that. And what I want to do is just focus on the investment performance for as long as I can.
Jimmy, I lied if you'll give me
And
a
I'm
little
with
bit.
you guys, by the way. I love the market. So doing this is like the greatest blessing in the world.
All right, so
you're
good. This
talking
is gonna be the toughest question anyone's ever given you. I really think highly of myself. What and by the way, I ask a lot of people this question, okay? Because I think if you really know your product and what you're doing, then you know what hurts you. So what hurts you? What are the economic scenarios that, like, is it something where all of a sudden Visa is outlawed? I mean, what could really crush you where you're like, wow, I don't think I saw that coming?
Well, I mean, you can see in those really sharp drawdowns that happen very suddenly, there's not as much room like in the Trump trade wars or even like during COVID. The 2022 is a little different because there was a lot to be avoided with some of like in 2022, it was the unprofitable tech that got crushed. It was like the Microsoft and the Googles and stuff. They went down a little bit, but they were just fine. So, so I would say what hurts me is like probably like just like a very sharp drawdown. And because you have some higher beta names, like you just get hit reflexively on that a little bit more than the market. And so like the Trump trade war is like a great example. Like you said, you lost a little bit more. But like, as you also mentioned, like the year before, you were leading it by double-digit percentages every single month or every year before that, and like continue to lead it by double-digit percentages to this year. I mean, I'm not too worried about the long term. I remember sitting there in 2022 and people were saying like there was a semiconductor glut, right? And Nvidia was down 75% and all this stuff. And like they were big, I had big holdings in them. And it's like, look, like I look forward into the future. Do we need more semiconductors? Like all the cars are supposed to be self-driving. Everything's supposed to be digital. Everybody's backing up 200,000 photos on their phone and their Ring doorbell. And by the way, they just put another Ring in the back of their house. And you're thinking like, oh my gosh, the semiconductor demand, like I remember Micron got hit really hard too. Like the advanced memory chip demand is enormous. And like, we need a lot more. And so there was a lot of people panicking, and those are the people that sell. And there's other people that are saying, these are incredible investment opportunities. The PE ratio is like Micron was, I think it went under 10, right? And they're just great opportunities to buy. And these are growth companies too. So when you see a company that's growing very quickly, like Google, before, like when Warren Buffett bought it, had a PE ratio of 18 and it has 50% earnings growth year over year and has been doing that for a multi-year period.
Yeah.
And you're like, that is, first of all, Procter & Gamble's PE ratio is like 30 something, and it hasn't grown at all in 5 years. So you're like, I mean, like there's certain things where you see the fundamentals and you trust the fundamentals and you trust the innovation is going to continue. And like, I believe that we're going to continue to need more software, more semiconductors, more payment technology, more financial technology. I mean, it's just common sense. We are going to automate more things and be able to do more with less. And if you believe in that, like that, this is the great opportunity out there. AI is like another word for like innovation using software, and being able to automate tasks, right? But that is the way the future is moving, and I believe it'll continue to move that way. And so I don't see that there to be very much risk, in my opinion, in the long term, right? So like 3-year period. I think when you talk about other companies, there's a lot of risk in the long term that you're avoiding.
Right. Okay. This has been a great conversation. I'm going to check with you on a later date because I have some questions about the machinations of bid-ask spreads for a nascent early stage, ETF when it's launched. You know what I mean? Like, are there algos that it can't? There has to be a relatively tight spread because every one of those holdings trades at a very tight spread. Correct. So there's
the spread right now. Like today, I placed the order in AOTG today. When I placed the order, I believe the spread was like 5 ticks.
Okay.
And so here's the thing, like I put in a market order myself, but I would always recommend people, especially when they're doing more, to do a limit order. But basically a lot of times you get filled at the middle of the bid ask spread. So there's a quoting mechanism. You guys are traders, you know this. There's a quoting mechanism, but there's also another mechanism market makers use that hits stuff like in the middle. Right. And so basically it doesn't maybe show the full volume there. It doesn't even show it up in the quoting, but it allows the people that are market makers to not get picked off when the markets move. So so I think a lot of times you get filled very close to the net asset value, but I think the worst case scenario, you're using a limit order, you get filled at the ask or something. And maybe that's 5 basis points away.
And again,
a wide market, right?
It was even a dumb question because who gives a shit? You know what I mean? If you're putting this on
good
for an investment,
bring it up. Sometimes.
Yeah. Okay. Good. Yeah. But again, if you're putting on it for investment,
we really care about it.
Exactly. I like to get a good deal. Right. Yes, exactly.
Yeah. I would think if you put in a limit order, you probably would be filled at a better price than that.
It's kind of like options markets and some things. You got to alert people to your bid if it's not. Yeah. Okay. So that makes sense. All right. Let's call it at that then. This has been
one more thing, Jimmy.
Go.
What's up,
one more thing, John. I'm going to give you 3 questions. You answer whichever one you want. Number 1, who is going to be the next Fed chair? Number 2, will tariffs be ruled against by SCOTUS? Number 3 is, do you want to know the best burger in the suburbs of Chicago? Pick one.
I do want to know the best burger.
Oh, well, you're in the exact right place. My restaurant consistently wins awards for the best burger in the Chicago area. Brant's of Palatine, 30 miles outside of the Loop, 10 miles
way.
outside of the city. Way, an old gangster joint, alternately owned by Al Capone's group. Roger Toohey, another gangster from the 1930s.
Where are you from? Arlington Heights or?
Well, yeah, just about Palatine, which is right next to Arlington Heights.
Okay, yeah, my grandpa and my mom grew up there, so she went to Mount Prospect?
Prospect is what they call it. Yeah,
Mount
Prospect is a town.
John, they know it if they were there.
They know it. If they're old and they've been in the
I'm
Northwest
going there
suburbs.
with my mom. My family still lives there, so I'm going next time.
Oh, text them now if they text and say, "Do you know Brant's? Brandts?" They'll be like, "Of course we know Brant's." Yeah.
And I went to Northwestern, so I spent.
Oh, so you know all of it.
Oh, I would drive like every other weekend to go see my grandpa, who lived in Arlington Heights. But I think you drive right through Prospect. So
right. Oh, you do. Yeah, exactly. All right. I got to go. I got a big game tonight. I'm coaching basketball at the local high school too. We got a big game. I got to start prepping for. No, I told the girls, by the way, we had our big team meeting. Like everyone's like, "Oh, you're so nice working with the kids." I'm like, that's bullshit. I am so hyper competitive that I want to get into a competitive thing for me. It's not for any of you.
He's humble too. He's humble.
Right. Anyway, okay, let's call it off. Remember, don't hang up real quick yet, John. She's got to capture your video. But thank you guys so much. The questions you guys asked is amazing. I hope you guys found as much value in this show as I did. I'd like to thank our sponsors again. Marco at Independence Arc Farm, grass-fed, grass-finished beef. It is amazing. You will like it. And he's also a great guy that we love to patronize.
Have you had his all beef brats, Jimmy?
They were fabulous, weren't they?
Oh my God, those are
they were so good. By the way, Monday's my fast day, so I haven't eaten in almost 24 hours. So this stuff, even talking about food, makes me crazy. Anyway, we covered Independence Arc.
Be coaching against you tonight.
Right, exactly. On to American Gold Exchange. The link is on our page. Dana Samuelson there will set you up with physical gold, physical silver. He is the guy to deal with. He's very trustworthy. Most importantly, unfilteredinvestor.com, which is Bobby and Michael's technical analysis. And I don't know what I provided the whole thing, maybe some sarcasm, whatever. But those guys are doing their technical analysis, and it's unbelievable. That is John Tinsman, who is the founder of AOT Invest, and the ticker symbol for his ETF is AOTG. Thank you. This has been the Futures Edge.